Welcome to Scope's Portfolio Manager Conference. My name is Manqing Sun, mutual fund analyst from Scope Analysis. For today's session, I'm very pleased to be joined by one guest speaker from Impact's BNP Paribas Asset Management, David Lee. David is portfolio advisor and co-manages the Asia-Pacific strategy. He's joining us on the line this evening from Australia. Welcome, David.
Thanks, Manqing. Nice to be here. Thanks, everyone, for your time.
The purpose of today's discussion is to hear about sustainability in an Asian context. Having acknowledged that impressive economic progress has come at the expenses of the environment, Asia's governments are spending increasing amounts of public money on sustainable projects. How can our investors seize those opportunities? Does ESG risk still come with territory? Please join our discussion today to find out why David and his team are excited about opportunities arising from Asia's so-called green revolution. At the same time, I encourage all of you to type in the question to our speaker. We'll either answer them during the meeting if time permits or reach out to you with more details afterwards. You could also view the full clip of replay on our platform, Scope Explorer. Let's start the session with a question on you yourself, David. First of all, tell us about yourself. What is your background relevant to the asset class and the region in particular, and what is your role in the team?
Thank you. So I joined Impacts about 12 years ago. So Impacts focuses on companies that are transitioning to adapt or provide a solution to a more sustainable global economy. So we invested in Asia about 12 years ago, and I was their first employee to identify opportunities for the global funds. And that culminated in the launch of the Asian strategy in about 2009. So I've been running that strategy since then. And today we have about 3 people based in Hong Kong doing research and portfolio management for Impacts here.
So to start our discussion today, could you explain to our audience what does green revolution mean? In the past decades, more and more governments in the emerging markets are getting the message, and we see a lot of efforts. We heard so many times about China, for example, has this carbon neutral target by 2060, and they set their eyes on the green technology in the upcoming 14th five-year plan. But apart from China, how about other regions in the Asian context? What gives the edge to Asia in particular against other emerging markets such as Latin America or Africa in this regard?
Yeah, so if you go to the next slide, I think, well, we have, that's right. I think the whole green revolution is really in response to the sustainability challenges that we face. And it's more acute in Asia, given a number of reasons, the demographics, a very large population base, and also urbanization into the big centers. So putting a lot of stresses on infrastructure, but be it just simple water or energy, but also other areas like clean transport. And against the backdrop of very constrained resources, we rely quite a lot on importation of energy, commodities, even other issues like pollution, which I think came about in the world kind of stage with the Beijing Olympics way back, but the pollution problem exists today. So these challenges are now more compounded by, climate change. So weather patterns are changing, floods and droughts causing disruptions in food supplies, health issues. So we're seeing a big response from governments, as you mentioned. Policies are very supportive in China, but not just China. We're seeing that carbon neutrality commitment from Korea and Japan, although not from India quite yet, because they're still developing, but they have energy intensity targets, they have renewable rollout targets, they have water quality targets as well. And more importantly, we're getting a very strong response from corporates and industries to become more efficient, both in terms of labor usage, energy and resources, and automating their production lines. And I haven't mentioned it here, but the last thing is really response from consumers. As we know, we are looking into plant-based proteins, low impact foods, more sustainable sourcing, packaging, for example, single-use plastics is topical. So I think the revolution is now really broad and really diverse. And it's important for us to really think about both the risks in terms of investing and the rewards, companies that can help us transition.
So speaking of regions, Europe, as we know, is relatively well established in ESG investment, be it regulations or investor consciousness. Has ESG caught up as an investment concept in Asia in general? Is adding ESG element truly appreciated as a source of alpha there? Could you give us some numbers? I'm sure our audience are also very curious about, for example, the number of inflows in regards to ESG funds in Asia, just to give us an idea about the involvement of this trend.
Sure. Obviously, I think people are also very confused about ESG. There's so many ways of defining it. The broader the concept is sustainability, which can involve investing in financials, as long as the financials are sustainably run. It could be even in fossil fuels, as long as they're run sustainable way. But then there are narrower definitions, and ESG is a narrower, more specific definition. And then there's impact funds, which is a bit like what we do at Impacts. We do measure the impact of these companies on the environment. So there are broad numbers, and I see numbers ranging from tens of billions to 200 billion that are being gathered in Asia in terms of sustainable assets. And these are driven by green bonds, which is about half of that number. Also sustainable funds, ESG funds, and then we also got passives, ETFs, which have this sustainability angle to it. Could be a negative screening kind of type of investment. So at the end of the day, when I looked at some surveys, Asian investors, more than half now, incorporate some form of ESG analysis in their investments. And so the idea is we're seeing ESG being integrated into the mainstream. And that's already happened in Europe, but it's increasingly happening in Asia.
We've already received a question from the audience. I'm sure we'll cover this in the second session when we talk more about your fund, about your strategy. The audience wants to know, does the fund follow any strict exclusions? In particular, it would be interesting if there are exclusion on military goods, nuclear energy, and fossil fuels, oil, coal, gas, or etc.
Okay.
So perhaps you can cover it in the later, second session when we talk more about your strategy.
Sure.
So we just covered the numbers, and the numbers, I'm sure, are indeed very encouraging, and it's very clearly an obvious trend. However, we also notice some concerns from our investors when it comes to invest in this region. Unfortunately, for ESG, as you mentioned, there remains a lack of universally accepted reporting standards. And we see efforts in Asia gearing up to facilitate ESG investment concept. Ping An Insurance Group, one of the largest Chinese investors in the equity market itself, has started to build a China-specific ESG rating system. And Hong Kong Exchange has tightened the ESG rules, etc. But to address some of the concerns from our investors, emerging market has historically been weaker on the transparency and accuracy of data disclosure. Could you weigh in on this? Do you think the market and the companies in Asia are ready to welcome a more stringent scrutiny on ESG data quality and ESG practice?
Sure. I think it's a pretty broad spectrum. We have very, very high quality companies, as well as very bad companies. The positive is that at the margin, we are seeing positive trends. So governments and exchanges tightening up standards in terms of governance. So be it the board, be it disclosure of governance practices, be it sustainability disclosures like water or energy or carbon. But it's incremental. So right now, it really depends on the asset owners or the fund managers to engage with the companies. And that's what Impacts does, spend a lot of our time. What we're doing is we're incorporating the ESG analysis as part of the financial business analysis of the companies. And when we actually visit them, we have to ask those questions and encourage them to adopt better practices. And the positive news is also that a lot of companies are ready. They're willing to also adopt these new suggestions that we give them. Although it takes time, it may not happen straight away. It's going to be at the margin, and it's going to benefit the companies. So, and the last thing I would say is the larger companies are obviously better able to do that because they have the resources. The problem with Asia is that we have smaller companies, younger companies who may not have the resources at the moment to do all this disclosure type, this burden on their accounting or non-financial disclosure requirements.
Okay. So we have so far covered a lot about the region in general. Let's come to your strategy, BNP Paribas Green Tigers Fund. Could you introduce to us about your crew, like in more further details? How many? You have 3 analysts, right, supporting the strategy. What their roles and relevant background? What does the in-house collaboration look like? Do you have access to BNP's research network?
Okay, if you go to slide 7. So this is part of our team. So this is the portfolio managers and research team. It's split between the US, London, and Hong Kong. And the way we operate is very flat. So our coverage is spread across all of these people, including London people covering Asia, and we tap into their capability. So it's not just the 3 of us. You can see myself here, David Lee, Oscar Yang below me, and then bottom left, Adam. We're based in Hong Kong, but some of our stocks are covered out of London. So Kirstine Morrison in the second row, she used to be based in Asia, so she covers some Asian names, Indian and Japanese. And then next to her is Justin Winter. He covers some Australian names. So the way we operate is that it's a very flat structure, and we do our own financial modeling. We do our own ESG reviews and scoring, and so it's quite a unique structure. And as you pointed out earlier, we can't really rely on third-party or publicly disclosed information, especially in Asia. So that's why we need to have quite a lot of resources on the ground to do this kind of work.
So let's come to your universe, investment universe, and how do you define a universe? What's your screening criteria? Could you also answer the question, does the fund follow any strict exclusion about on military goods, nuclear energy, and fossil fuels?
Sure. So on slide 9, you can see how we have defined environmental markets. And it's evolved over a period of 20 years. So Impax has been working on this environmental investing since the beginning, and we don't do anything else. And this classification is also adopted by FTSE, where you can also get a range of indices, environmental indices. So when we first started, it was more to do with energy, alternative energy to start with. So you can see it's very narrow and very cyclical and very techy. But over time, we started to move into energy efficiency, which has very broad applications like power networks, industrial manufacturing, buildings, transport, and consumer. So even within that, there's many end markets. We also add water. So it could be a utility, very safe company. It could be infrastructure, which is cyclical. But it could be treatment, which is very high margin and very steady. We added pollution control. So be it water pollution or air pollution, in there you got some specialized equipment like testing and sensing, and public transportation. And noting that testing and sensing has many end markets besides water. They also supply into healthcare or food and agriculture, which we then added also 7 years ago. The entire food chain, value chain has been added to our universe, ranging from irrigation to pesticides and packaging and logistics, and low impact foods and nutrition. And last but not least, the waste and recycling reuse market, the circular economy is also included. So this is how we define environmental markets. And to answer the question about exclusions, first and foremost, Impax does positive screening. So we look at what the companies do. So they have to do something involved in these markets in order to get involved in our universe. And for this fund, the minimum is 20% of their revenues. So we go to the company and we just go line by line to calculate this. But the average purity of this fund is about 65%, because there are some pure play water companies, pure play renewable companies in here that we have in the portfolio. As to exclusions, yes, we do have exclusion. So the typical ones would be, as the gentleman mentioned, Felix, military, child labor, obviously drugs, pornography. As to fossil fuels, we don't screen them in because they don't fit into our classification. So they may be in here, but up to a certain point. We do exclude if it's over a certain percentage. And same as nuclear energy. It doesn't get screened in, but if it's above a certain percentage, we also exclude them. And the problem is for nuclear is the decommissioning of nuclear, which we're concerned about. And obviously fossil fuels. In this case, we do natural gas utility companies because they are displacing coal companies, especially in the China and India space, where coal is a serious pollution problem, and natural gas is a transition fuel, which is significantly less polluting and less carbon intensive.
I think there's a follow-up question, but you don't see nuclear as clean energy, right?
No, because of the lack of solutions for decommissioning and treating the waste materials. That's the problem with nuclear. So strict exclusions would be, as I mentioned, the armaments, so weapons, anything to do with supply policies like child labor or sourcing from conflicted countries. So there are strict exclusions. And to be honest, we often don't come across them because we positive screen in the first place. So a lot of sectors are not in here. So we don't really have financials. We don't really have the big internet companies. We don't have oil and gas. We don't have any coal. We don't have any kind of extractive industries in here by default because of the way we screen in the companies. So we don't really need to have a huge negative screening device because you can see companies that are involved in these sectors tend to be naturally the environmental companies.
So the fund achieves, let's look at the performance. The fund achieves a very strong performance, beating the peer group average throughout 1, 3, and 5-year investment horizons. That's quite impressive. Since inception, the performance per annum is almost 4 times the peer group average. What is your key alpha source?
So I mentioned several already. We don't do financials, and obviously financials have been quite challenged. We also don't do oil and gas, so extractive industries, and they also have been very challenged. We tend to overweight industrial tech. You can see how energy efficiency, alternative energy, and even some of the water and food areas, they are actually more science-based industrial technologies. We don't invest in kind of very leading edge kind of inventions. We basically buy technologies that are being applied to environmental markets, so proven ones. And for that matter, things like industrial automation, industrial software, the Internet of Things, and obviously we also have a bit of renewables, not a lot. So we're not a renewable fund, but we do have about 10% in renewables. And as you mentioned, with this carbon neutrality commitment towards the end of last year by China, Japan, and Korea, and also Biden winning the US presidency, we had a very strong tailwind in renewables towards the end of the year. And with the automation and software and Internet of Things, obviously with electric vehicles being strongly supported out of Europe and in China, we also get benefits there. So these will be kind of the main drivers. And at the end of the day, we're a stock picking kind of fund. We pick the best ideas in these sectors. We're not constrained by kind of sector allocation. We don't have to own anything. If we don't like any company, even in a good sector, we can choose not to own them, mainly for valuation reasons. So we're quite valuation conscious as well.
So in the year of 2021, for the past 3 months, we see a below peer group average performance. What is the challenge there? Where do you see the challenge? Have you made any changes in this regard?
So a few headwinds in the first couple of months. So the financials turned around. So I think the market was looking at long bonds, the yields rising. So that's good for financials. So obviously we don't own financials. So in Asia, we do have quite, the MSCI Asia does have quite an overweight in financials. And so that's a headwind. The internet giants, Tencent in particular, it's very big and they had a good run. So those would be kind of the areas that people have to think about when they invest in these type of funds. We just simply don't invest in these companies. I think most investors already have quite an overweight position in those markets anyway, because they all would have some Tencent or some HSBC or some other financials in their portfolio. So we don't hold those, and we make that a point. In addition, some of the names I mentioned, industrial tech, automation, there has been a bit of rotation and a bit of profit taking going on there as well. They've done really, really well over the last couple of years. But we are not concerned, given that we do see the very long-term tailwinds behind these companies. We have trimmed a little bit and rotate into some of the laggards. For example, North Asia has been very strong, and we're rotating into South Asia and also India. In some of the non-tech, maybe some of the consumer names that are really lagging because the COVID situation in South Asia and India is still very challenged. But it's early days. We've made some trimming here and moving the assets over, but it takes a little bit of time for the market to move. In the very short term, it is going to be very volatile. But I think the themes that we're looking at are very long term. And I think one thing to note is that the 5-year plan came out from China, the 14th 5-year plan. Initially, there was a lot of expectation because there was this carbon commitment. But I think the market was slightly disappointed with it because not much detail came out. But what we're seeing is that it seems like the Chinese government is pushing a lot of the onus to a lot of the industries and the provincial governments. So we expect them to come up with their own version of carbon neutrality in the near future. And also the carbon market, which has been announced at a national stage, but have yet to release any details. So if we see more details on that, we expect China to also start to rely a little bit more on market mechanism to direct environmental investments rather than in the past where it's all kind of top-down administrative measures and dictating what's going to happen. So these will take some time, but I think it's a very, very bold and aggressive environmental target that China has put themselves into, and I think we should see some follow through.
Yeah. So let's now take a deeper dive into the current portfolio. Where do you see the best investment opportunities across sectors at the moment? Could you highlight some themes where you see great potential and maybe give us some examples?
So if you go to slide 11. So the heading COVID-19 investment implications may sound like just very short term, but actually it's very sustainable, very long term. It doesn't just cover COVID-19. And these are the names or the sectors I've mentioned already. So overall, we've been looking into digitization and Internet of Things, health and safety and well-being, industrial automation, also sustainable food and water. So these are the ones that have been reinforced by COVID, because I think with a lot of the climate disasters that we've endured over the last few years, that has reinforced people's minds. Also, the single-use plastics programming, the David Attenborough program that aired, also reinforced the focus on sustainability. And COVID, again, reinforces concerns about supply chain security, like people will rush in to buy toilet paper, couldn't get their masks. So this focus on how do we make our supply chains more sustainable, more resilient? How do we make our transportation much more safer? And the youngsters are thinking about sustainable foods, low impact foods. So I think these are being reinforced, and we're very comfortable that even if COVID goes away, on people's minds would be these sustainability challenges. So they were the positives. On the right-hand side, the red sectors are the negatives. And we're mostly not involved in those sectors with the exception of a couple. So I mentioned the plastics alternatives. Single-use plastics was on the way out, but because of COVID, people have relied on single-use plastics again because of concerns about the pandemic. So that's taken a back step. And the other one would be public transportation. which in Asia is growing very fast. There's a big build out of electrification of rail and subways and electric vehicles. So that has taken a bit of a back step because concerns about catching the virus. And I think that will come back in time, especially in very congested cities like Hong Kong, where there is really no alternative to public transportation, and they're very well run companies. So we stuck with the MTR as an example, but we did have a Japanese equivalent, and we sold out of that one because we felt that it'll take longer for Japan to come back because there's a tourist element to it, and also because Japan has alternatives to subway because it's a much bigger place, whereas in Hong Kong it's really either the bus or the subway. So these are some of the thematics that we think of, and you should find in our portfolio.
So compared to the benchmark, the portfolio largely underweights some of the hotshot names of Chinese tech giants, such as you just mentioned, such as Alibaba, Tencent, Meituan, and Ping An, who we just said is designing a dedicated ESG rating system. Why is that? What's your thought behind it?
Yeah, so if you go back to our classification on slide 13, so a lot of companies, when they look at ESG or build an ESG fund, they look at how a company is run, right? So it's how they are run. They don't really care what they do, as long as they're run with environment, social, and governance factors in mind. This fund is unique. We care what they do. So they have to do something related to these markets. So a Tencent doesn't do any of these things. Neither does Meituan or Alibaba. Technically, we can invest in a financial company if the financial company, like a bank, does a lot of financing for water infrastructure, for example, or energy or renewables. So if that bank has 20% of the loan book, 20% or more of the loan book involved in these markets, then we will invest in that financial. But otherwise, it's not in our universe. So that's how we operate. That's why we call it an impact strategy. We calculate the impact in terms of carbon savings, the water savings, water treated, waste recycled at the end of every year, and we verify those numbers and we publish and send to our investors to show them what kind of impact their investments have made in this transition to a more sustainable economy.
So, okay, well, where else do you see opportunities other than Chinese markets?
So at the moment, China is the biggest market in terms of producing and consuming environmental products and services. The other big producers of environmental solutions obviously will be Japan, Taiwan, and Korea. So mainly in energy efficiency, mainly in automation, Internet of Things, which are being applied in many end markets. In terms of consumer of these products and services outside of China, it'll be India. India faces very similar issues with China in terms of a huge population, air pollution and water pollution problems, water scarcity across the board. China is water scarce in the north. Also, we have big urbanization trends in both countries. India population is still growing. China is not growing, but they're moving to the city. So combined, China and India have about 700 million people moving into city centers over the next 3 decades. So there's going to be serious infrastructure challenges to accommodate this kind of migration. So those will be the main areas in terms of suppliers and consumers of environmental products and services.
Okay, so we have another question from the audience. Biodegradables are cited among the losers post-COVID. Is it possible to elaborate on that a bit? At first glance, biodegradables should be more conducive to sustainability. What can be the possible dynamics that put it out of favor?
No, I don't think it's out of favor. It's just that I think because of the huge demand for disposable items given the pandemic, that people had to resort back to the quick and dirty plastics. But as the supply chains, and also because of the supply chain problems, people couldn't get to these things. They have to get whatever was available. So we need supply chains to normalize, for the manufacturing capacity to increase, and maybe for the cost of these things to be lower. So it's a matter of time. I don't think it's a long-term trend that will go away from biodegradables. They will come back in time. But at the moment, the supply chain is in disarray, and so I think it's, single-use plastics is the lesser of two evils right now. The pandemic is the worst things possible. So in order to avoid that, they don't mind the single-use plastics. Yeah.
So another question from the audience, what about the social aspects in China? Do you use ESG ratings or in-house? I think you use in-house research, right?
Yeah. The ESG ratings we sometimes use for screening purposes when we screen a lot of companies. But the problem with third-party ESG ratings, they cover the very big companies. What we look at, you can see the sectors that we look at, they tend to be mid and small cap companies. A lot of them don't have third-party ESG ratings anyways. So we take it upon ourselves to do the rating in-house. So it's a proprietary engagement process, which is also continuous. So we refresh our ESG ratings every year, and we also pick out engagement priorities. For example, a lot of discussion about Xinjiang at the moment, about the forced labor, and because the solar value chain does have exposure to Xinjiang manufacturing. Basically, the upstream polysilicon is made there because of the low energy costs up there. So obviously, we will then pick out the companies that are involved in that value chain, supply chain, and engage in these companies, ask them what's going on, where they're getting their polysilicon from, are they in any way using forced labor, where did they get their people from. So we score the companies ourselves, and if they fail our ESG minimum score, then we are restricted from investing in them. And it's independent of the analysts. So the ESG scoring is done centralized in London, and all the analysts will have to submit the data, and we internally will do the scoring independent of the stock analysts. So that's how we work.
Let's talk about risk management. The strategy shows a higher volatility compared to its peer group across periods observed. How do you protect downside? What do you think about the overall risk for your portfolio?
So if you go back to slide 12, I didn't bring my the detailed numbers with me, but it's difficult to compare peer groups because there isn't one, to be honest, in Asia that does what we do. Because you can see how we are very specific in terms of the stocks we look at. We're not a very broad sustainability fund where they can have very big banks and big insurance companies. So they would have big caps, whereas we have mid-small caps. So I might believe that's one reason why the volatility comes out that way. Because you can see the top left chart, the market cap, we don't really have that many mega caps. We have more mid caps. So the size effect is what's showing up in that volatility number that you probably saw. When you look at our numbers compared to the MSCI in terms of the beta and in terms of the vol, we're actually very similar. Our beta is around 1 typically, and our volatility is around 13%, whereas the MSCI vol is around 12%. So just a little bit higher. And you can see the bottom right, our cyclical defensive posture at the moment. For a lot of times, we are more defensive than cyclical because we do have a lot of water utilities, chassis in our portfolio. But it is transitioning. The Asian economy is transitioning, and we're finding a lot more ideas in the energy efficiency area, which are more techy, more industrial focused. Electric vehicles, for example, which is very popular. And then we're talking about hydrogen, which is not yet in the portfolio, but it's being talked about and we're investigating there. So that again is kind of more like an industrial application. So therefore, in the recent year, our cyclical exposure has gone up and our defensive exposure has gone down. But that could change over time, depending on the opportunity set that we see. but we're not too cyclical, right? At the moment, we're just slightly above the MSCI.
Yeah, so I think there's still a lot of curiosity about the social aspects from China, but in the interest of time, we'll cover it if time permits, or we will reach back to you with more details afterwards. So given the nature of the strategy, do you think there's a higher risk of sector clustering? If yes, how do you tackle that?
It can be. If you go back to our classification on slide 13, there are some funds out there which are very focused. So there are energy funds that only do energy. So in the past, we've had this issue. Like when we first started 20 years ago in our global fund, it was very risky. And that's why we've gone down the route of deriving this kind of definition of what we mean by environmental markets. And at the moment, it's very diverse. So we believe we can have very diverse portfolio, and we also have soft limits. So we do look at end markets like construction, like automotives, like consumer discretionary. So we define these into what we call end market risks, and we make sure none of our portfolios have more than 10% in any of those end markets. We also look at country. We have defined limitations on country exposure. We also have liquidity limitations and also ESG limitations. So if we have low scoring ESG companies in aggregate, they cannot exceed a certain percentage of the portfolio. So these have been developed over the years to help us run the portfolio in a more kind of a safe and diversified fashion. So that's why we end up with the numbers I showed you. You know, the beta is very close to 1, and the volatility is just slightly above the MSCI.
So let's wrap up today's discussion. First, I think our audience is really curious about how, what's the challenge there, what are the key barriers to sustainable investment in Asia, especially for China. Is it challenging for the companies to meet the social aspect from your point of view? Could you elaborate more on that?
Okay, I think a lot of people don't find the connection in the first place. They don't find the connection of good ESG behavior and performance, although that's changing. One of the reasons is that I think in Asia, people do have quite short-term investment horizons. To do this, I think you need to have more conviction and longer-term horizons. So our holding period for our stocks are very long. So at least 2 years, but typically 5 years. You need to have that kind of horizon to see through the benefits. And there's increasing empirical evidence to show that good ESG companies do outperform. There is not a cost. It's not a cost for you to invest in good ESG companies. And I think the industry is only starting. When I first started this strategy 10 years ago, we had to identify these ourselves. There isn't a ready sector. There's no company. Well, there's also greenwashing, so you've got to be careful. Some companies just say they're green, but they're not necessarily green. So that's another issue. And the last point is that you need to know what you're doing. We pay a lot of attention to the policies. We pay a lot of attention to the technologies. And so it's not an easy way of investing. It is very bottom up, very labor intensive. And so, there are some ETFs out there which have become very popular because they're easy. But they are typically kind of negative screening type funds. They just screen out certain sectors and claim to be ESG. So we feel that there's still a place for actively managed ESG or sustainable fund.
So what is driving investors internationally towards sustainable products nowadays? Is it because they have a mandate, or for compliance reason? Do they anticipate risk return will actually be better than non-sustainable investments? Could you weigh on this more general overview?
Yeah, we like to think so. I mean, we try to outperform the MSCI, and over the long term, we have been able to do that. For some of our asset owners who invest in our funds, they do have mandates, their trustees, so increasingly so. And it started with fossil fuel divestments, and then it kind of included other, some of the exclusions that was mentioned in the chat, and increasingly looking for impact. They want to see impact. How do you measure it? How do you define it? So it comes from many angles. So the asset owners, it comes from performance, and also comes from government regulations. Increasingly, governments are putting more onus on the corporates. So disclosure, as you said, is still early days, but we're seeing more of it. So as companies need to disclose, they'll start to think about how they can do things better. A lot of them have the data, but just don't have the resources to show you. So if you ask them, a lot of them do have how much water they use and how much energy they use, and they can just measure the impact they have on the broader economy. It's just that people are just starting to ask those questions, but increasingly they're being asked a lot, and so they will change.
Mm-hmm. Thank you very much, David, for the wonderful presentation on our topic today and your strategy, BNP Paribas Green Tigers Fund. Thank you. Unfortunately, in the interest of time, we have to stop here. I'm sure we have also a lot of follow-up questions regarding this fund, and we're happy to take it and collect it and send it to David, and David would happy to reach you back with more details. I hope you will leave better informed and potentially excited about the opportunities from Asia's Green Revolution. Thank you all for joining us on the line today. Have a wonderful day and see you next time.
Thank you.